Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Let's get to Amy Glaser, Senior Vice President at the talent and employment firm Adecco. She joins us from Florida this afternoon. How would you describe, Amy, the corporate pace of job postings today? Because over at Adecco, you all have such a great view of what's going on when it comes to the supply side and also the demand side.
Yeah, we're still seeing job openings outpace the job worker that's looking for a new job. So we're at about 1.1 job openings for every candidate out there seeking employment. So we're still seeing stability, a resilient labor market continue.
So in terms of any differences, Amy, compared to, 6 months ago, compared to a year ago, is it better? Is it the same? Is it showing some slight weakness?
So I think there's a lot of noise in the month of January, specifically this year. So we dealt with some calendarization with New Year's falling in the middle of a work week, which always puts off new hires and starts. We also dealt with the weather impact, both between the wildfires and the Arctic blast. So there's a little bit of noise there that makes it really hard to understand what the trends look like. We're not seeing a dramatic difference right now. And basically, from a lot of the employers I'm talking to, there's quite a bit of optimism as we go into the next couple of months. We
have been trying to figure out the economic impact of the devastating wildfires in Southern California. What insight did we get into at least the labor side of the disruption of those last month?
Yeah, definitely geographic impacts both on the West Coast and then up in the Northeast. It varies by industry as well as by specific location. We see, especially on the East Coast, a lot of manufacturing was hit, as well as on the West Coast. And we'll continue to see things rebound. In fact, we're seeing a little bit of an uptick already with construction and relief efforts and things of that nature. So it's just a really fluid and moving dynamic sector right now.
Hey, one of the things I want to ask you as we await for President Trump to make some comments along with the Japanese Prime Minister. They have been meeting today. They are expected to hold a press conference soon from the White House. We'll take everybody live there when that happens. In the meantime, though, Amy, how much of, I'm curious, the conversations you are having with your clients, with corporations, or those who are involved in corporate hiring, where they're saying, you know what, we're just going to kind of take it day by day, week by week, month by month until we get more clarity about policies coming out of the White House?
Carol, you're exactly right. I think it's too soon to tell. We're monitoring it closely. Other employers are monitoring it closely. I will say the one thing that really employers have in the back of their head is going through COVID taught them this sense of resiliency and how to quickly adapt and be agile and shift. So I do think there's a sense of confidence within the employers that regardless of what the policies shake out at, that they will be able to adjust and swiftly take action to ensure business continuity. So I think that's what they're focused on right now.
In terms of companies not being able to get all the employees that they need, how does migration into the U.S. factor into the equation and how that could go down during this administration?
Yeah, I think we're all still watching to see what the full impact of that is. Obviously, the laws of supply and demand will still exist. If there are less employees out there, we could see things like wage pressure start to increase as we move on. So we're really just watching it cautiously optimistic at this moment, but only time will tell.
What about in terms of what we are seeing in regards to wages? Our Mike McKee was just giving us a lowdown on the stats we needed to know coming off that monthly jobs report, talked about average hourly earnings increases with an explanation of that. But what are you seeing from clients who are looking to hire? Are they having to pay up? Are they having to, it's the same as we've seen over the last 6 months? What are we seeing?
I think it's very comparable. Carol, we are seeing this time of year seasonally in January, a lot of companies give annual raises, so that's another just kind of common sense reason why we might see wages uptick a little bit in January. We did hear some whispers in November, specifically in the warehouse transportation along with seasonality, that there could be some wage pressures and base pay rates starting to increase, especially in the blue collar sector. So we're just kind of waiting to see if that's a trend that's going to continue or if they were simply whispers that are going to die out.
Based on what you know from your perch at Adecco, should the Federal Reserve be more concerned about the labor picture of its dual mandate or about the inflation picture of its dual mandate?
You know, Tim, I'm not an economist, but what I can tell you is I do think the market is going to continue to remain strong. Layoffs and quits continue to remain low. So as long as that continues, I think, you know, it's up to the Fed to decide what happens there. But I can tell you, I do see an ongoing, steady labor market in the U.S.
Amy, just 30 seconds left here. If you had to take, you know, kind of one word or one quick description of what's interesting about today's labor market, what would that be?
I think stability and steadiness. And it's kind of refreshing that we continue to see six-digit, you know, improvements in new job ads.
All right, we're going to leave it there. Hey, listen, thank you so much. Enjoy the weekend. Amy Glaser, Senior Vice President at the talent and employment firm Adecco, joining us from Florida.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Hey, Paul Sweeney and Alex Steele, a little earlier, they were talking about this on Bloomberg Intelligence a little earlier.
Super Bowl ads, right?
Yeah, the prices for Super Bowl ads have risen to a record of over $8 million. Sponsors purchasing around 10 of the most expensive 30-second spots for the broadcast on Fox. Paul noting he remembers when it was a big deal that a 30-second spot went for a mere $1 million.
Yeah, $8
so
million.
15 or 20 million.
Yeah.
They were 15 or 20 years ago.
Yeah.
So.
I mean, it sounds like a lot.
Okay, for more on marketing around the big game, we welcome in David Jones, CEO of the Brandtech Group. It helps brands make their marketing more efficient using technology. He joins us from London. David, good to have you with us. AI and marketing. Why do we need people if we can just ask AI to make funny ads for us?
Hey, the human in the loop is still really important.
Okay, good. That's what I wanted to hear.
But you know, I think there's a bit of a debate going on at the moment. People think, but I'm a special creative person, and AI can't possibly replace me. And it's not the point. The point is, this is the most incredible tool. And I think personally, we're going to see the greatest creative revolution in history. But it's about humans using and leveraging these incredible tools rather than getting worried about whether they're going to replace them.
All right. So does that mean, though, in terms of ads, I guess it doesn't matter in terms of cost. It just means it costs less to make these ads. Like, I think about the Super Bowl and I kind of look forward to the ads, although I feel like sometimes they're not as exciting as they used to be. Tell me, first of all, about that market, because they just get more and more expensive, it seems. I mean, what does it do for a brand, David, to have a spot during something like the Super Bowl where the audience is massive?
Well, look, I mean, very simply, you know, we know we're living today in a world where there's just an avalanche of content. We're in the attention deficit economy, and it's harder and harder to reach people. But one of the things that still works are big live events, as we've seen. I mean, last year, 123 million audience at the Super Bowl. I'm pretty certain we're going to see a record this year. You know, this is a Super Bowl that kind of has everything. It's got Trump, it's got Taylor Swift, it's got Kendrick Lamar, it's going to have that record audience. But actually, I think the thing that interestingly is missing and what we're talking about is Gen AI. Now, you might say, but hang on, you know, we've heard that OpenAI are taking out their first ever Super Bowl spot. In fact, their first ever paid advertising. We've got Google doing AI ads and GoDaddy and Meta. But actually, all of the ads that we're going to see in the Super Bowl on Sunday, or certainly all the ones we've been teased so far, a lot of them are talking about generative AI, but none of them are actually using generative AI to create the content.
What does that say to you?
Well, I mean, it says to me that ad agencies have got a lot of catching up to do. And why do I say that? Because if you look at the content that's being put out in the world at the moment using Gen AI, it's just absolutely spectacular. But it's all being done by creators. And actually, there's quite a seminal moment last summer in July when a creator created a spec ad for Volvo in under a day for a couple of $1,000. And you look at it, and it's every bit as good as the TV commercials for car brands that are costing $1 million and taking 6 months. And I think, you know, almost if you look at, we've just lived through this enormous revolution of the creator economy. Today, there's 250 million people who make a living in the creator economy. And we kind of like to say that if the mobile phone turned everyone into a creator, generative AI turns everyone into an ad agency. And I think this, for me, will be the last ever Super Bowl we see without, an enormous amount of Gen AI content in it.
We'll hold you to that in a year.
That's pretty wild, though, David. When we think about disruption and what AI, I kind of get it in the creative universe, but what does it mean for all the artists are out there? Is it mean more work because they can produce a lot more content and maybe the cost goes down and more people will tap into the creation of ads and marketing? Or does it mean a lot of folks who are now designing ads and content will not have a job anymore?
So look, I mean, it's interesting. When the camera was invented, one of the famous French painters said, this is the end of painting. And actually it wasn't. It was the birth of Impressionism. I mean, I just made the point that, we now have 250 million people in the creator economy. So look, probably the best analogy I could give is if you were to kind of compare it with human aviation. So if you can imagine, thinking back to those early attempts of humans to fly, and you're watching someone who's built this contraption, they kind of fly 300 yards and then plummet into the ground. When you're watching that, it would be impossible to comprehend that there would be a time where 4 billion passengers flew around the world, where there'd be new jobs like air traffic controller and pilot, and those lovely people who take our liquids in the plastic bags as we're going through the security machines. The biggest retail luxury shopping centers in the world would be in the airports of Paris and London and Singapore and Dubai. And it's a very similar thing. We're at the start of this revolution. And of course, humans are always worried. They go, oh my God, it's going to replace us. And I think if you look back over time, that's actually never been the case. And personally, I don't believe it's going to be the case this time around. I mean, in the 1800s, over 95% of the population worked in farming or making food. Today, it's less than 2%. So logically, no one should have a job, but no, we just do different things. And I think that it's just, if you spend any time playing with the tools and looking at what they're able to do, it's just spectacular. I mean, Google launched VO2 at the start of this year, and it's mind-blowing what it can do already. And we'll look back in a year and think that what it can do now is pretty average.
Well, so play that out for us a little bit, with the farming analogy. I like that one a lot, and help us understand what it will look like in the future. I mean, if we think about it from the perspective of, okay, this is what people used to do. What are we going to be doing, 5-10 years from now that we can't even imagine?
Well, look, I mean, we work with 8 of the world's top 10 global advertisers, 60 of the top 100. And what they have seen really quickly is just how game-changing this is, because it kind of solves the holy grail of marketing, is that you can create content that is better, faster, and cheaper. So literally in the last 3 months, we've created 235,000 pieces of in-market content for 3 of the world's top 10 global advertisers. And across that content, it's been created 62% faster, 55% cheaper, and delivered a 40% better return on investment. And I think that's what's so amazing. It's not just that it's sometimes better and sometimes faster and sometimes cheaper. It is always better, faster, and cheaper. And I think that's going to be pretty game-changing in terms of the impact that it has, for all brands and in and around marketing and advertising. Now, what it's going to do, obviously, we think that every major global advertiser is going to be able to reduce the amount of money they're spending on content by, at least 30%, probably 50%. And then they can decide, do you take that and put it back into media spend and spend more, buy more Super Bowl spots because you've got more $8 million to spend if you're not spending millions on the production side, or do you take it to the bottom line? And so, look, we're going to go into this incredible revolution, this incredible, and we're going to see a huge shift and a change in how marketing works. I mean, there will be an expectation that we all have hyper-personalized content. We're talking about the Super Bowl. If you think about the famous Nike and Adidas ads everyone grew up with, I mean, every single person on the planet, if they want to, will be able to see themselves, playing basketball against LeBron one-on-one as if it was shot like that at high quality by a director. And then we can get into areas like share of model. And share of model is the whole concept that, in the previous decade, it's been where do you perform on search. In the next decade, it's like, what do the LLMs think of your business and brand? And we did a piece of research over 60% of people under the age of 30 are now finding out and being influenced by their choice of brand or product by the LLM. So we're heading into this kind of pretty wild new marketing world. And I think it's coming at a speed that I've never seen in my career.
Well, so, it's one thing when I was listening to you that when we think about one of the concerns on the market today, obviously tariffs were at play. There was some economic news in terms of consumer sentiment and inflation expectations among people thinking that prices will be higher. But I do wonder about, do you buy into that AI, certainly when it comes to the marketing world, the advertising world, it is going to cut costs a lot?
Oh, I mean, on the content creation side of things, it's dramatic. I mean, those stats I quoted aren't sort of like hypothetical. I mean, it's not just that it's going to cost a lot. Your content will be better. You'll be able to create it faster, and you'll be able to create more of it. And this is all interesting because we're going to head into a world, and obviously everyone is talking about the agentic future, and it's all about agents. And I'm not sure if you played around with Operator that ChatGPT launched a couple of weeks ago, but I literally got up one Saturday morning and I ordered my bread from the local bakery and the juices, and I booked my hotel in Paris, and I looked for Soccer World Cup tickets, and I sent through emails, and it did it all seamlessly.
So explain what it is for people who don't know what it is. It's basically a personal assistant that, you're the one used to doing that Googling, or an admin will do that for you. But this agent, who you'd pay, what, $200 a month for it?
Yeah, so anyone who had the kind of top level of ChatGPT got it. Yeah, I mean, basically what it does is it is working in your browser, and it goes off and does all these things for you. And every now and again, it comes back and says, hey, you have to authenticate that you're a human because it's not so good at doing the captures and all of that. But it was remarkable. And I think this tech revolution is different on three big levels. The first one is it's happening faster than any technology revolution we've ever seen. I launched Australia's first internet agency in 1998, and none of us in 1988 thought you would ever watch a video on a computer. Now when I fly back home to New York on Sunday, I'll be streaming Netflix on my mobile phone at 40,000 feet. But that took 20 years. The same level of progress is taking months now. The second thing is the early versions of this technology are really very good. If we think about what the precursor to the mobile, the iPhone, it was the Newton and the Palm Pilot, and they were terrible. And then the iPhone was amazing. But again, it took 20 years. The first version of Operator, I was able to literally do stuff, transact immediately, and it was good. And it's just going to get better and better. And I think the big difference than any technology before is we've never created, it's more than a tool. We've never created a technology before that can think for itself. And that's why every single major CEO of any tech company is saying, this is the biggest invention in humanity.
Well, David, just got about a minute left here. How did DeepSeek, the news that we got a couple of weeks ago, how did that change or impact everything in terms of the conversation around AI? Does it just feed into, again, it might not be as expensive that everyone thinks it is?
Yeah, look, so I think you could, whether you think that DeepSeek was an amazing advance in artificial intelligence, or just proof that humans aren't that intelligent and stock markets just go on a run at the slightest thing, or both. I think, look, DeepSeek wasn't any better. What was interesting about it is it cost $6 million to train, not hundreds of millions, and it used kind of mid-range NVIDIA chips, not top end. But this is going to happen every week. I mean, every month someone's going to come out with something new, and if every time someone comes out with something new and great, the markets go up and down, it's going to be a fun time for day traders. But I think it was a great step forward. But then obviously, if you spent any time asking it about Tiananmen Square or the South China Seas, it was quite interesting. It would give you a great answer and then immediately wipe it out. So at the time when people are worried about TikTok being owned by China, is the US going to build its kind of whole AI infrastructure on a platform like that?
All right.
I don't think so.
Interesting stuff about marketing and ads and Super Bowl and, of course, AI. David Jones, thanks so much, CEO of the Brandtech Group, which helps make brands makes their marketing more efficient.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Adam Greenblatt is BetMGM CEO. BetMGM is the sports betting and iGaming operator. It's jointly owned by MGM Resorts International and Entain. Adam joins us from New Orleans. Adam, how are things going ahead of the big game this weekend in New Orleans?
Well, things are going great. There's been an incredible amount of preparation for what will be the biggest day of the year for us. BetMGM is really prepared. We're offering more markets on this single event than on anything else in the year. We've got a bunch of promotions lined up, VIP activations. So a lot goes into the preparation and execution, and the energy in the city is amazing.
How important is a day like this for you guys in terms of your bottom line?
So it's interesting. So it really depends on how the money falls. So where if there's a balanced, if betting is balanced. So by contrast to last year, where certainly for BetMGM, we had a lopsided book. So a lot of money on really then the Chiefs. This year has been a lot more balanced. So while the Chiefs are the favorites for Sunday's event, the money is going on the Eagles at the moment, and an Eagles victory would be great for us. And it would be a very good day, but won't make the month, won't make the quarter, based on how the money is distributed today.
Oh.
In terms of growth, what is give us the trajectory here? Because now that in many parts of the U.S. this is legal, and indeed we're just seeing it grow in terms of where it's allowed, what can you tell us about growth?
Well, the growth trajectory has been remarkable. It's hard to fathom, really, that the industry was only legalized in late 2018. We now have sports betting legal in 38 states, and we have iGaming legal in 5 states. BetMGM, we've just put out our 2024 earnings release. And we've announced that we're now generated in 2024, we generated $2.1 billion of revenue. We've guided to $2.4 to $2.5 billion of dollars of revenue in 2025, and growing strongly. And within that, both sports betting and iGaming are really showing incredible growth. And I think we still have a lot to go. And I think this is the important part. On the iGaming side, we exited the fourth quarter of 2024 with 55% year-on-year growth of active players, and this is on a same-state basis. So the depth and interest in the sector is remarkable. And on the sports side, the handle, which is how much people bet, was up in the fourth quarter 40% year-on-year. And this, I think, is just, we have a long runway ahead of more state adoption in sports. But really, in terms of the state adoption, the addressable market is more vast in the world of iGaming.
I'm having trouble understanding the difference between sports gaming, gambling, and iGaming. What's the distinction?
Yeah. So if you want to play a hand of poker, if you'd like to spin a roulette wheel, if you'd like to sit down at a virtual poker table with a real live dealer, but on your computer, on your phone, you can do that. And that's what we refer to as iGaming. And sports betting is the thing that it's the underlying event is a sports event.
So iGaming is online gambling that's not related to sports.
Correct.
Where's the growth, or the most growth coming from?
The growth is everywhere. So on the sports side, the growth is in deeper market penetration. So that's one. So more states, and within the existing states, more recreational adoption. One of the beautiful things about this game this weekend is that it has such tremendous reach. So I'll give you an example of why that's relevant. So in terms of the markets we offer, BetMGM is offering over 1,500 different ways to bet on the game this weekend. And of course, you have all of the usual suspects, the total, the money line, the spread. But we also have for this game, how long is the national anthem? What's the first song in the halftime show? Is Travis Kelce, this is in Ontario, is Travis Kelce going to propose to Taylor Swift?
What's the biggest bet that people are playing with right now?
The biggest bet, well, in terms of money or in terms of interest?
Oh, gosh.
Interest.
I'll take both.
So the vast majority of bets are on what they term the traditional six-pack. So who's going to win,
right?
by how much, and how many points are going to be scored. And it's the over and under on those latter two. And so that's where probably 60% of the betting volume will take place.
Right.
In prop bets, which are things that are outside of those big game outcomes, it's who's going to. One of the things that BetMGM offers is our touchdown market. So we offer a wide range of who's going to score first, how many scores will Saquon make, what's the longest touchdown going to be, and that's almost like a thematic family of bet types, which we're leaning into. That's proving very, very popular as a prop bet for our players. But again, to the previous point, we also have a very, very popular prop bet, coin toss. So who's going to win the coin toss? And one of the reason this is so interesting and popular, because you don't need to know anything about football. Right. It's the oldest yes or no bets in the world. 50-50 odds. You don't have to know anything about odds, but it's there. And just for what it's worth, 65% of bettors think it's going to be a Chiefs winning the coin toss.
Hey, Adam, what do you say to those folks who say, this has gotten out of hand? It's too easy for us to part with money. It's too addictive with our smartphones. There needs to be some sort of, not ban, but, sports gambling has gotten out of hand. What do you say to those folks?
So really the topic that's at the heart of your question is responsible gambling. And BetMGM is very, very committed to our responsible gambling obligations and we put our money where our mouth is. We're investing real hard dollars in research. We have a relationship with MGM Resorts and NFL teams that we're advertising responsible gambling messages in stadia. We're investing in a partner called Kindbridge, which offers support and referrals, counseling services for those who self-exclude. So people who are saying, look, my gambling, I'm not comfortable with. I'd like to sit out, and so we offer counseling services for them. We also have already now multiple years a very deep relationship with something called GameSense, which was the pioneering, really the gold standard in responsible gambling messaging and education and support. And that's just a sample. We've also, for example, we've got now in the NFL the program for the day. Every single person that in the stadium will have access to. We have a full page responsible gambling advert, which stars Connor McDavid, one of our BetMGM ambassadors. Really, and these are just examples of the sincerity with which we approach this topic. And frankly, it's existential for the industry. All of the operators, all of the leading operators certainly are very committed to this cause. We've got together and we formed something called ROGA, the Responsible Gambling Association, where we are seeking to create a universal and nationwide self-exclusion register to make sure that we're looking after players in a coordinated way. So there's a lot going on, but the topic is very important.
Do you feel like it's working, the awareness, and making sure that people aren't getting into trouble who probably shouldn't?
I think we're certainly making progress. We're certainly making progress. Yes. Is it working? Is the impact of our initiatives, is it making an impact? Yes. Are there always vulnerable people that need to be protected? For sure. But for me, I see this as an opportunity and the most compelling argument for why it should be legalized everywhere. Because it is naive of us to believe that it's not happening illegally offshore. And I don't. In the intro, you referred to the AGA's market sizing. How many bets are going to be taken this last year? It was in the 20s.
Yeah.
This year, it's in the 1 and 1.4. Well, and that's because there's so much illegal activity taking place today, where those bettors are not being protected supported. And frankly, states are losing out from tax revenue that can be reinvested in these types of important topics.
We certainly hear you. Adam, thank you so much. Adam Greenblatt, he is BetMGM Chief Executive Officer with the big game and the betting that's happening.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just about 18 minutes or so left to go before we wrap up the Friday trade and the week overall. We've got stocks hovering, bumping along the bottom here. You just heard Charlie and Bill Maloney talk about the trade. NASDAQ 100 down 1.3%, the most on a percentage basis of among those large equity averages. I look at the S&P 500. Most names are lower, 364, Tim, to the downside, 136 to the upside. So, yeah, we are seeing a bit of a risk-off trade, and safe to say some concerns over some of the economic data that we got earlier, concerns about inflation, and then more talk of tariffs, again, feeding into that inflation fear.
Well, let's talk a little bit about that with Andrew Krei, Co-Chief Investment Officer over at Crescent Grove Advisors. Andrew, back with us from Milwaukee, Wisconsin. Andrew, how are you?
I'm doing well. How about you two?
Yeah, we're doing pretty well. We finally made it to Friday, which is a surprise because this felt like the week that would never end. I guess we're not there yet. We do have about 18 minutes to go until the close of trading here. As Carol mentioned, there is some concern when it comes to tariffs. We saw that with the confidence numbers that we got earlier today. How do you think about tariffs, not just the prospect of them, but the way that they can change consumer confidence?
Sure. Well, I would say one thing, what we're seeing today, we're investors, not traders. But if I was a trader, I probably wouldn't want to be long going into a weekend where there could be even more headline risk around tariffs and these sorts of things. So I think it just sort of changes the dynamic day in, day out. Again, doesn't necessarily affect the way that we think about deploying a portfolio on a 3 or 5 year basis. But I think the confidence number is a great indication of just kind of the weight that can have, the toll that it can take. Also, the 1 year forward inflation expectations that we saw in the University of Michigan survey. I think that certainly ties into the tariff picture. So it flows in through all sorts of different avenues. I think from our perspective, still base case, though, is that it's more bark than bite. So, we're going to see a lot of headlines. We're going to see that sort of rhetorical risk that bubbles up to the surface. We're going to see volatility day in, day out, week in, week out. But at this point, we still think it's probably not going to materialize into anything that's going to derail what looks like a reasonably good year for corporate profitability.
So it all comes down to that. However, if we start to see growth slow down, would you think differently in terms of the pressure that might come on corporate profits?
Without a doubt, right? I mean, I think that's what we're watching just to see how acute are these tariffs actually going to be in terms of their impact, strip out the rhetorical piece of it relative to what is actually going to impact corporate profits. We're watching it closely, but again, our base case at this point is that it's just not going to be impactful enough to derail what looks like a reasonably good year for corporate profits.
Andrew, why do you think it won't be impactful enough? Because they won't last for long, they won't be as severe, they'll be very limited, there'll be exemptions. Why?
Yeah, I think it's the limited nature, sort of the scope. Ultimately, I think it seems like sort of an exercise in terms of just drumming up the base, getting enthusiasm around the rhetorical side of it, the sort of political theater around these sorts of things. There will be pockets of impact, no doubt, but we think ultimately that's the focus right now, is to create the kind of flow of headlines and that sort of thing to generate some political victories. And then at some point too, we think, okay, the focus then shifts towards taxes, tax cuts, making the tax cuts permanent, that sort of thing, and the tariffs perhaps fade into the background.
Do the tax cuts become a reality given the split Congress? And I shouldn't say it's split, it's all Republican controlled, but it's very close.
That's right. Yeah, I think there's definitely going to be some wrangling to be done around just the concerns with the deficit, and will this be something where they can find areas where they can continue to raise a little bit of revenue to perhaps offset what's become a very large deficit that we continue to run. I think all told, they will find a way to get it done. I think there's enough political will for that at this point in time, and I think the consequences of the other side of it, if they don't get it done, I think could be pretty bad, right, for markets, certainly. And that's something that we're attuned to in terms of risks on the horizon. But at this point, again, our base case is that they find a way to get that done.
All right. So you got to put new money to work. Investor comes to you and says, here, I've got X in my portfolio. Where do you put it to work right now?
So the working theory that we have here is that we've talked, I think the last time I was on with you all, we talked about the sort of relative value rotation that we're expecting to play out over the balance of this year now, but over the next, call it 12 to 18 months. And the way we see that sort of working is that, the DeepSeek scare, I think, was front and center in terms of the kind of risk to growth stocks right now. So we'd be a little bit more cautious around U.S. growth stocks, probably not putting money to work necessarily there, new money to work, but looking at more of the value side of things. So financials, industrials, things that would benefit from, again, a sort of broadening of corporate profitability, broadening of growth in terms of EPS growth, and a convergence between growth stocks and value stocks in terms of their relative earnings. And then ultimately starting to see, IFA's done pretty well this year. If we get a little bit of momentum there, maybe on a 3 to 6 month horizon, there's a U.S. value to DM international rotation. And then after that, if we kind of start to see this continue to play out where, it's not as bad as we think from a tariff perspective, then we see DM international, Europe, Japan rotate into EM, which would be kind of the final frontier of the high beta play on a reasonably good global growth backdrop going forward. So that's kind of how we're seeing the next 12 to 18 months play out.
So where do you not want to be?
Well, I think it's mega cap tech at this point. And maybe it's not that we don't want to be there, but just from a market cap weighted perspective, if we're thinking about an S&P 500 portfolio, take it where it is today with 30 some odd % in the Mag 7, give or take, or the top 10 names, we'd rather be a little bit underweight in that segment right now. And I think, again, the DeepSeek headline that we saw, the reaction off of that, I think was just indicative of how sensitive those names would be to a potential derating if the narrative gets challenged at all.
I think everybody is trying to challenge it and I think try to figure it out. I mean, where are you? Are you kind of on the fence about, okay, maybe they've got something? I mean, technology tends to innovate, disrupt, get cheaper, right? We know that that's often the cycle. It might take some time, but are you kind of on the fence whether or not this AI spend, the billions and billions of dollars, whether or not that still makes sense or whether it might not?
I think that's the big question. I mean, these companies went from, in some cases, very capital light to very capital intensive businesses. And if they get this wrong, in terms of the return on invested capital, or at least if they're not quite as right as they think they're going to be in terms of the ROI that they're going to generate on these investments, at some point then it's sort of malinvestment, right? And at least it sort of would cause you to not want to pay the types of multiples that we've been seeing, 30 plus times now, 35 times on the Mag 7 basket. If you want to think about that as kind of an index in and of itself. That just seems like it's a pretty premium valuation relative to take an S&P 500 equal weight, trading at around 17 times forward earnings, and we get a broadening of earnings growth story, as I alluded to before. That to us seems like a pretty good relative value trade-off right now. Again, not to say that these mega cap tech companies are bad businesses, or they're going down, they're going to zero or anything like that. It's just, I think the relative value opportunity to us is what looks so appealing.
Andrew, gonna have to leave it there. I love the idea of sort of being underweight big tech.
It's pretty interesting, right?
Yeah.
Well,
that's
yeah.
What makes a market.
Like, do you wait a little bit? And if you start to see a lot of investors doing that, we know how important they've been to propping up the overall market indices, and that pulls things back.
Andrew Krei, Co-CIO over at Crescent Grove Advisors.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.